Good afternoon. It's Monday, September 14th, 2015. This is Michael Douville in beautiful, gorgeous Scottsdale, Arizona. It's late in the afternoon, so the markets have closed. I need to get my disclaimers out in that I am not a stock and bond licensed dealer, nor am I a financial advisor. I am a real estate investment advisor. I've done investments for a long, long time. I'm reasonably well versed in alternative investments as well as mainstream investments. So let's just get cut to a couple of things. I just want to bring this to one's attention. And in listening to Lakshman Akuthan with Economic Cycle Research on Bloomberg this week, he mentioned that China in 2011, 2012, and 2013 used more concrete in those 3 years than the entire United States did in the 20th century. 3 years versus 100 years, they used more concrete. They also use more iron ore, copper, coal, oil, lumber, anything that any natural resource. They had an insatiable demand for it. They were building. Now, the reason for this is that we ramped up $3 trillion. They ramped up $21 trillion. So their debt load is pretty significant. And they just built. They built their infrastructure, but they built houses. Now, here's another startling thought. In the entire United States, as old and as wealthy a country as we are, we have 118 million residential units. Now, that includes the condos and apartments, and that includes single-family homes, duplexes, whatever it is. These are single-family residences. In China, they have 52 million vacant properties. 52 million vacant properties. They have whole cities that are sitting there empty. They have shopping centers, largest shopping centers in the world, empty. They have bridges going to nowhere. So that has stopped. It's slowing down. It's coming to a halt. So you can see this is happening. You can see all the prices are dropping since 2013. For the last year and a half, prices have just been coming through the floor. Everyone's function on is focused on oil, but of course I have friends in Australia. They were just bragging at the iron ore, because iron ore ran up to $195 a ton. Now it's $45 a ton. So if you built a mine thinking you're going to get $100 a ton, or $150 a ton, or $195 a ton, and now you're getting $45, you are losing your shirt. And that's what's happening around the world. So all these emerging markets that are resource-rich that have been selling to China, well, China is slowing very, very fast. Matter of fact, we've got deflation going on around the world, and it's accelerating. Matter of fact, if you read today in Economic Cycle Research, they posted that the deflation is accelerating, and at such a rate, they've never seen at such a rate without a recession. And we're not in a recession. Now, we could be entering one. We're slow enough around the world. Of course, Canada's in a recession, but the United States has not. They're warning that if we have these prices dropping in a non-recessionary environment, a slow one, but non-recessionary, when we get to a recessionary, it's going to be a policy nightmare. And in particular, when we have the Federal Reserve that's really out of ammunition, things can be really, really tough. So I'm warning you, I'm pleading with you, please, if you've had your money in the stock market, take half off. Take 60% off, take 75% off. Put it into cash, and let's see what happens for the next 6 months. Maybe I'm wrong, in which case then you probably have lost a little time in the stock market, and it's certainly not going to double in 6 months or so. If I'm right, then you're going to save yourself a lot of money. And here's my other concern. Martin Armstrong, an incredibly smart man, is saying that the interest rates are at a 5,000-year low. 5,000 years. Can they go down a little bit more? Maybe. Are they going to be this low in 5 years? Probably not. I don't see how that would be possible. You have negative interest rates. You're actually paying money to the banks to hold your money in Europe. We haven't gotten there yet, but we're, an eighth of a point or a tenth of a point. Something ludicrous. So we're thinking in 5 years' time, these rates probably going to be off these rates. So that puts the bond market at risk. Now, you also have in the bond market risk, you have default risk. So how many of these bonds were sold to, like particularly high yield bonds, were sold to the mining industries, to natural resources? These guys are in deep, deep trouble. They're not going to be getting out of it at any time soon, and particularly on the oil. So if you've got any high yield bonds, you need to get out of them. Muni bonds, they're at risk. State bonds, they're at risk. Already Chicago has got junk status rating. It's funny, there's some things going on in Illinois, but Illinois had a couple of lottery winners. They're not getting paid. I don't know if that's because of their budget or whatever it is, but they're like $10 or $12 billion back before they can pay anything. So you've got lottery winners who have won the lottery, can't get their money. So that tells me it's a huge, huge warning sign. So, I can't imagine U.S. Treasuries defaulting. I certainly can think of some municipals defaulting. Could Chicago default? Sure. Detroit? Sure. Puerto Rico's already talking about defaulting. So, they're saying, hey, we're not going to pay the bondholders. So, yes, they're already in. I don't know if they're technically in default. They've already said we're not going to do that. So, sure. So, if you have Puerto Rico bonds, you are in trouble. So, those are muni bonds. They could be stretched out all across mutual funds. So, you really need to take a look at what's going on. So, not only do you have a default possibility on these muni bonds, you also have an interest rate. So at this juncture, what I would say to you is that you probably do not want to take any more, but you really want to take a close look at your municipal bond portfolio and try and think of maybe it's time to sell part of it. If you had any kind of bonds for any time, you've had a very good profit. So at some time along the line, you have to ring the register, and by golly, now it's time to ring the register. So I would say to you, take half, take 3/4 off. Get into something safe. Take some cash, real cash, 20s, 100s, 50s, 5s. Real U.S. currency. Put them in your backyard. Put them in your next door neighbor's under his rock or something. Go hide it somewhere so that you've got that, and put it into cash. Put it into put it around in savings accounts. Keep in mind that you have $250,000 that we have in insurance. But I would make sure that I spread that money around. But here's what we're going to say. This sounds counterintuitive, but here's a commodity that people are going to have to use, and that's single-family homes. Everybody needs a place to live. Everybody needs a place to live. So if you start losing some cash flow from dividend-paying stocks, because keep in mind, if things start slowing down, which I think they are, then I think you're going to see your dividends get cut. If you're in the high yields, they may not pay you if they have a default, so you really need to look at that. So how are we going to pick up some of this cash flow? I'm going to tell you from experience, because here I am in Phoenix, probably one of the poster children for what went wrong in the 2008 real estate bubble. We survived that, and we prospered. And I'm going to tell you how. Our rentals just continued to cash flow without ever skipping a beat, because our people everyone needs a place to live. Now that's not to say our tenants didn't have some problems. People, I think, if we're going to have jobs, are going to be affected. It's your management becomes a little challenging. You have to work with people, but our cash flow remained reasonably consistent. And here's what happened is that as our properties were affected, our vacancy factor went down. We had hardly anybody moving around. As we progressed through it, taxes came down, the insurance came down, maintenance came down, management costs actually came down. So whatever we didn't get on rent, really, we got that back in some of the expenses that we didn't have to pay. So I'm going to tell you that if you're looking for a little safer haven, I wouldn't take all that money and plow it into real estate at this time, but I would certainly take a portion of that and get it into real estate. And here's a couple reasons why. First off, we're going to cash flow. You're going to get an income coming into you, and that's going to be very, very important. If you're a business owner, or like I am, business gets affected by it. You still have bills to pay, so you need some kind of an ancillary income coming in. This will certainly provide that for you, and it's like getting a CD at a bank. You don't get a whole lot of return, but it's reasonably safe. Now, prices can certainly go up and down, but we're real estate. We look 5-10 years out. 5-10 years from now, I think we're going to be fine. I just think we have in the next 18 to 36 months we have some problems. After that, I think we're just fine. Now, but here's what's not going to be available in 3 or 4 or 5 years, and that is not going to be available is going to be these mortgages like they are now. For the life of me, I just don't see you having them. So we can get interest rates under 5% for a rental for a little single-family home. I would highly recommend that you put some leverage down on it. Typically, I mean, here in Phoenix, we have such great little properties. You know, you can buy a property under $200,000 that's going to cash flow for you. So if we put half down, you're going to be guaranteed a cash flow, and you can get rates 4.5 for an investment property. Now we have a window now. I think come January, February. I don't think we have that, but we do now, and I would highly recommend everyone get into there and just load up the truck with these interest rates that you can get. And I would go look, speaking of that, I would just go look at whatever you have in your portfolio, and if you can refinance it, I would refinance that. And and here again, we want to get your properties as quickly free and clear as possible. So I would not say, extend out that amortization too terribly long. You can take a 30-year mortgage. If you save $4,000, make sure you put that $4,000 down on your principal reduction so we pay these loans off, because we want these loans paid off. But that's great principal reduction, and you can get really good money. And so at this point, I would say you want to borrow as much as you can. I mean, most of the corporations in America are just loading up at 2, 3, 4% bonds, so you should be too. Now, this has kind of been a little longer video. You're welcome to call me. I have a whole team here. We'll take very, very good care of you. You can be the landlord if you want, or you can just be the investor and we'll be the landlord and take care of everything for you. But please, 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 you're welcome to call me, talk to your investor, talk about an exit strategy so that if things do go bad, that you can get out. So listen, this is Michael. I'm here in Scottsdale, Arizona, and I'm wishing you the very best. Bye-bye now.